In this video, I will discuss something about the mutual funds. And this is a first part of the video. So here, definition of mutual fund, its peculiarities, and the types of mutual funds will be discussed. In the next video, I will be focusing on the challenges, advantages, and the condition of mutual fund in India. So let us come to the first part of this discussion on mutual fund. So we are going to see what is meant by the mutual fund. Okay, these are the important things which we will discuss: mutual fund meaning, concept, types, advantages, problems of mutual fund. So what's the meaning of mutual fund? A mutual fund is a financial intermediary that pools the savings of investors for collective investment in a diversified portfolio of securities. So mutual fund is a financial intermediary, just like banks or some other non-banking financial intermediaries. As banks do, these mutual fund also collects in money from the people, and on behalf of the investors or the people who give money to this mutual fund, they invest this fund in a diversified portfolio of securities. So they will invest funds in different the shares of different companies and in debt instruments like the treasury bills or government securities. So they will invest this fund in many type of diversified securities. So a mutual fund, in short, is a financial intermediary that pools the savings of investors for collective investment in a diversified portfolio of securities. A fund is mutual as all of its returns minus expenses are shared by the fund's investors. So that's why it is called mutual, because returns minus expenses. So whatever the company gets, mutual fund company gets, minus expenses, that will be shared among the fund investors or will be shared among the people investing in the mutual fund. A mutual fund in India can raise resources through the sale of units to the public. So this is how mutual funds raise resources. It will sell units to the public. So if you invest in mutual fund, it does mean that you are investing or purchasing unit. That's the term used, unit, not the share or the equity. It is the unit you are supposed to be purchasing when you invest money in mutual fund. Say a mutual fund in India can raise resources through the sale of units to the public. A mutual fund serves as a link between the investor and the securities market by mobilizing savings from the investors and investing them in the security market to generate returns. So they mobilize savings from us, they take savings from us, they collect money from the people or investors, and this money is invested in security market in different shares, in different debt instruments, and so as to generate a return for you. So actually you are engaging in stock market operations indirectly through the mutual fund. That's the meaning. So it is very helpful for those who have means small amount of money to be invested in the stock market and who have no expertise or who have no professional knowledge in investing in stock market. They can easily take mutual fund as a route through which their money can be channelized to the stock market. So in short, a mutual fund serves as a link between the investor and the securities market by mobilizing savings from the investors and investing these savings in the securities to generate returns. As a mutual fund is akin to, it is the same as the portfolio management services, PMS. So mutual fund, simply speaking, is a portfolio management service. What the both are conceptually the same, they are different from each other. So a portfolio management and the mutual fund, they are conceptually the same thing, but a little bit different. You can observe in between both. Portfolio management services are offered to high net worth individuals. So that's the difference. Portfolio management services, PMS services, or companies offering PMS services, they offer this service to high net worth individuals. Who are high net worth individuals? Big people or the rich people. But in the case of the mutual funds, savings of small investors are pooled under a scheme and the returns are distributed to the unit holders. So even the low net worth individuals or even the individuals with less money, they can also invest in mutual fund. That means if you have 100 rupee or 500 rupee or 600 rupee, 1000 rupee, then also you can invest in mutual fund. So portfolio management service or companies offering portfolio management service cannot cater to the demands and cannot cater to the requirements of the small savers. But mutual fund can cater to the requirements of the small savers because mutual funds stand to collect fund from the people. Even if a small amount, it will collect fund from the people to be invested in security market. So conceptually, both mutual fund and portfolio management services do the same thing, but there's a little difference that portfolio management service does this work mainly for the high net worth customer, but mutual fund, they do this service for all people. For all people, they do this service generally for unit holders, and their returns are distributed to the unit holders. And there are some concepts related to this mutual fund. First concept is net asset value. What is net asset value? Simply speaking, net asset value is asset minus liabilities. Asset minus liabilities. In other words, this amount which the shareholders will collectively get if the fund is dissolved or liquidated. So this is amount which we get by selling our unit. And this is the amount at which you will be purchasing a unit also. The net asset value of a unit is the net asset value of fund divided by the number of outstanding units. This NAV, market price of securities plus other assets, minus total liabilities, units outstanding as at the NAV date. So simply speaking, net asset value means the asset minus liabilities or minus expenses, minus liabilities. This is what is called the net asset value. Look at this sentence. Net asset value is a price at which an investor can buy or sell a unit of a mutual fund scheme. So normally we buy and sell the unit of a mutual fund at the net asset value. So it is the price at which the investor can buy or sell the unit of a mutual fund scheme. Another important concept related to mutual fund is expense ratio. What is expense ratio? It's the ratio of expenses incurred by a mutual fund for managing a fund to net assets, managing a fund to net assets of the fund. That means expenses divided by net asset. The ratio of expenses divided by net asset. What does it mean? We know that the management of mutual fund requires a lot of expertise, a lot of professional knowledge from the part of the people managing this, because they have to always look at the market trend and they have to calculate each and everything. They have to understand the changes happening in the economy, because they stand to protect the money of the investors. Therefore, the success of a mutual fund, how much earnings a mutual fund receive from the market, that totally depends upon the mutual fund managers. Therefore, the mutual fund company has to spend a lot of money for managing the fund. Expense ratio means what is the ratio of expenses incurred by mutual fund for managing the fund? How much a mutual fund spends for managing the fund to net asset of the fund. Net asset means asset minus liability. So that is what is called expense ratio. So this is very important. If the expense ratio is very high, it means that the mutual fund company is spending a lot of money for professional management of the fund. And if expense ratio is very high, then naturally what happens, the unit holders are likely to get means return for their investment, because NAV will be very less in that sense. So expense ratio simply means it is a ratio of expenses incurred by a mutual fund for managing a fund to net asset of the fund. The expense ratio represents the proportion of the fund assets that go toward the expense of running the fund. As I already explained, it is the expense of running the fund. Expense ratio includes expenses such as management fees, salaries and bonuses paid to the top management and sales personnel, administrative cost, legal audit fees, marketing and selling expenses, and other miscellaneous expenses, and commission paid to the distributor. All these things will be included in expense ratio, or under the head expense, you will include all these things: salaries and bonus paid to the top management, sales personnel, administrative cost, everything, every cost that you may have to incur to manage the fund, that will be included in expenses. Expense ratio is the cost of owning a fund, while load is a cost of buying a fund. So load means cost of buying a fund. If you have to spend some money for buying a fund, then that's what's called a cost, load. But expense ratio is the cost of owning a fund. A load is paid directly by the investor to the fund at the time of buying. So when you buy an NAV, you are expected to be paying a load also. The expense ratio is disclosed by a mutual fund house once in every 6 months. Means it is mandatory for a mutual fund to disclose its expense ratio once in every 6 months. What is entry and exit load? This is another important concept that generally comes in the case of the mutual fund. Mutual funds incur certain expenses such as brokerage, marketing expenses, communication expenses. And these expenses are known as load and are recovered by the fund from the investors. So when mutual funds company starts selling a product, starts selling a fund, so we will see different types of funds. So when mutual fund company starts selling a fund, it will have to incur certain expenses, such as sometimes brokerage fee may be given to the brokers. Marketing expenses are there because advertisement cost is there, and also communication expenses. And these expenses are called load, and they are collected from the investors by the mutual fund. In other words, load is a sale charge or commission assessed by certain mutual funds to cover their selling cost. So it is nothing but the selling cost. Selling cost means the cost on advertisement, the cost on brokerage, the cost on communication. So therefore, that selling cost in mutual fund language, it is the selling cost which is considered as the load. Loads can be of two types: front load, front end load, and back end load. What's the difference? Front end load, it is otherwise known as sale load, is a charge collected at the time when an investor enters into the scheme. So when you purchase a unit, you have to give the sale load. So it is a charge collected at the time when an investor enters into the scheme. Back end or repurchase load, it's a charge collected when the investor gets out of the scheme. So when you sell the unit, you may have to give a repurchase load. When you buy the unit, you may have to give a sale load. Sometimes that do not charge a load or card. Sometimes in some cases, mutual funds do not charge any load, no load schemes. Such schemes are known as no load schemes. These no load schemes can have an exit load when the unit holder gets out of the scheme before a stipulated period mentioned in the initial offer. NFO, that's my NFO. New fund offer or initial offer. So suppose that you have purchased a unit for 6 months. So 6 months is the maturity period, but you are going to sell the unit before the stipulated period of time. Then you may have to give an exit lot. Even if the scheme is no load scheme, then also you have to pay the exit lot if you sell the mutual fund unit before the expiry of the time or before the stipulated time. If you are selling the mutual fund, then you have to give what is called an exit load. So there are scheme or funds which charge a load, or which some funds do not charge a load. Even in the case of the funds charging no load, then also exit load may be applicable. SEBI abolished entry load for all mutual fund schemes launched on or after August 1, 2009. So it must be understood that now there is no entry load. Now there is no entry load. Entry load means the load or the sale load that you need not pay, because from August 1, 2009, the SEBI has abolished all entry load for all type of mutual fund schemes. And there is another important concept which usually comes in the case of the mutual fund is asset under management. The mutual fund manager mobilizes funds by offering a scheme which are then deployed in various assets or securities. Market value of these assets is known as asset under management. Simply speaking, suppose the mutual fund management is investing in the Reliance company shares. The market value of that asset, how much money the mutual fund company has invested in the share of the Reliance, that is what is called asset under management. Asset under management of a scheme is calculated by multiplying the net asset value of a scheme by the number of units issued by that scheme. For example, net asset value is 100, number of schemes or by the number of units issued by that scheme is 100, then it does mean that means 10,000 rupee. That is what is called asset under management. So how much assets, how much value of the asset is, that is the asset under management. So market value of these assets is known as asset under management, and asset under management of a scheme is calculated by multiplying the net asset value of a scheme by the number of the units issued by that scheme. Now, who can invest in mutual funds in India? So many people can invest, but at the same time, some people cannot invest also. For example, foreign citizens, entities, they are not allowed to invest in mutual funds in India, but we have to see whether there is any change or no in it or not. But resident Indian individuals, including high net worth individuals and the retail or small investors, Indian companies, Indian trust or charitable institutions, banks, non-banking finance companies, insurance companies, provident funds, non-residents, including non-resident Indians, foreign entities, namely foreign institutional investors registered with SEBI. All these people can invest in mutual funds in our country. How the mutual fund is organized, or how is the organization of mutual fund? Three key players, namely the sponsor, the mutual fund trust, and the asset management company, AMC, are involved in setting up a mutual fund. They are assisted by either independent administrative entities like banks, registrars, transfer agents, and custodians. This figure shows the idea of the organization of a mutual fund. First, we have the unit holder, then trustees, sponsors, asset management company, mutual fund, transfer agent, and then we have a custodian. Custodian means depository participant, because they actually keep all records. And finally, we have a regulatory agency called Securities Exchange Board of India. Who is a sponsor? Sponsor means any person who, acting alone or with another body corporate, establishes a mutual fund. So who is establishing a mutual fund? A person establishing a mutual fund, that is, that person is known as sponsor. Sponsor simply means a person establishing a mutual fund. A person who establishes a mutual fund is known as sponsor. If mutual fund can be sponsored by a bank can start a mutual fund. Any financial institution can start a mutual fund. Foreign company can start a mutual fund. Indian company can start a mutual fund. So as of now, there are 39 mutual funds in our country, and means the number may have gone up, but we say that the around 39 mutual funds are there, and 4 are bank sponsored. Life Insurance Corporation is sponsoring one. Many entities are sponsoring mutual fund in our country. Then a mutual fund in India is constituted in the form of a public trust created under the Indian Trust Act 1882. So a mutual fund is constituted under the Indian Trust Act of 1882, and the sponsors forms the trust and registers it with the RBI. Most of the funds in India are managed by the Board of Trustees, which is an independent body and acts as a protector of the unit holders' interest. The trustees on the Board of Trust of the fund hold its property for the benefit of unit holders, which are the investors. What is an asset management company? The trustees appoint the asset management company with the prior approval of the SEBI. The asset management company manages the fund by investing in various securities. AMC, our asset management company, that's a company which manages the fund. They are appointing professionals for the managing of the fund. So we have to give it, the mutual fund company has to give a money to this asset management company, AMC. So asset management company manages the fund by investing in various securities. Who is a custodian? Custodian is responsible for safekeeping of cash and securities of the mutual fund. That's a custodian. Registrar and transfer of agents. They accept and process investors' applications, handle communications with investors, perform data entry services. So agents generally do these works, dispatch account statements, and so perform such other functions as agreed on an ongoing basis. So these are registrars and transfer agents who do certain backdoor or backup activities in the case of the mutual fund transactions. Let us see what are the types of mutual fund. We can classify mutual funds on different bases: functional basis, investment pattern basis, portfolio objective, and geographical and other basis. Based on function, we have 3 important mutual funds. One is open-ended schemes. Are those schemes where investors can redeem and buy new units all throughout the year as per their convenience at NAV related prices. So anytime you can buy, anytime you can buy, means sell. That's open-ended scheme. Closed-ended schemes are open for subscription only for a period of time. So always you cannot buy it. Closed-ended scheme means always you cannot buy it. You can sell it, but you cannot buy it. So these are open for subscription only for a specified period. Interval scheme means this combines the features of both open-ended and closed-ended schemes. They are open for sale or redemption during a predetermined intervals. During the interval, you can buy and sell it. So this is based on the function. We have 3 kinds of mutual fund: open-ended schemes, which can be bought and sold at any time; closed-ended schemes, which can be sold at any time but not bought at any time. There's a period for subscription. Interval scheme means during the period of certain predetermined intervals, you can buy and sell mutual fund. Portfolio classification. On the basis of the portfolio, or it is divided into 3. Bank income funds. Income funds means the aim of the fund is to provide safety income of safety investments and regular income to investors. So this fund will be very safe and you will be getting a regular income. You need not take any risk. That is the income fund. So growth fund is riskier because in growth fund, the main objective is capital appreciation. So they invest most of the corpus in equity shares, which is with significant growth potential. But the problem is that it may invite a lot of crisis also, a lot of insecurity also. Then the aim of balanced fund is to provide both capital appreciation and regular income. So combining the features of income fund and growth fund, we have the balanced fund. Then other mutual funds are exchange traded funds, real estate funds, etc. that we will see later. Investment classification. On the basis of the investment, you can classify the mutual fund into equity fund. Equity fund means your money will be invested in the equities of the companies. So if funds of a particular scheme are invested in equity shares, then it is an equity fund. Debt fund means funds are invested in debt instruments. So if the fund of a particular mutual fund is invested in debt instruments, then it is called a debt fund. For example, investing in government securities, other money market instruments, etc. So they are very low risky investment, low risky investment. But the problem is that return will be low, and at the same time, high liquidity will be there. Then hybrid investment means in order to provide the benefits of both equity and debt investment to the investors, we have started there are mutual funds offering hybrid fund, combining the features of both equity fund and debt fund. Based on geographical classification, you have again two types of mutual fund. One is domestic fund. They mobilize resources from a particular geographical area, for example, from a country. Offshore funds means they also attract money from outside. So offshore funds are mutual funds which collect money even from the foreign countries, or which collect money from the foreign countries or foreign capital for investment. Then there are three kinds of diversified equity funds. So equity funds itself, you can classify into three. Large cap fund. What is a large cap fund? These are funds that make investments mainly in the shares of big companies. Big company means company with a capitalization of more than 1,000 crores. Mid-cap fund means those funds investing in companies with a capitalization between 500 crore and 1,000 crore. Small cap fund means funds investing in companies with a capitalization of up to 500 crore. So this is a basic difference among large cap fund, mid cap fund, and small cap fund. And there is another value fund. Value fund means funds invested in undervalued stocks, but with strong fundamentals, but they now perform very poorly. Underperforming funds, due to a lot of reasons, especially due to difficult phase or economic downturn, they may be encountering certain issues, but they have strong fundamentals. So that is called a value fund. Special fund means mutual funds have launched special schemes to cater to special needs of the people. Because some mutual fund may say that we will return the money upon retirement. So when you retirement scheme, when you retire, we will give the money. A child care plan, that's a ICICI child care plan, is an example of this special fund. UT Mahila unit scheme, especially for the Mahila or the women. So these are special fund. Sectoral funds, these funds known as thematic funds. Thematic funds restrict their investment to a particular segment of the sectors. For example, funds investing only in banking sector equities. So they will collect money from us and they will invest only in the banking sector equities, SBI or HDFC, ICICI banks. So they will invest only in such securities. Some may collect money from us and they will invest only in IT securities, IT equities. So these are called special fund. Funds investing in certain special sectors. Derivative or arbitrage funds. These are open-ended equity schemes aimed to generate low volatility and better returns by investing in a mix of cash equities, equity derivatives. So we will discuss the derivatives later. So funds investing in derivatives, and that is called derivative fund. Then tax saving schemes, because some mutual funds collect money from the people for giving a tax saving privilege to the customers. Tax saving schemes are equity oriented schemes and they collect money from the people for exclusively for the tax exemption purpose. Index funds. An index fund is a mutual fund which invests in securities in the index which is based on BSE index or Nifty. Index fund. Fund of fund. What is a fund of fund? Fund of fund schemes invest in the combination of equity and debt mutual fund schemes available in the market. So if you invest in a combination of debt and of equity and debt mutual fund schemes, then that's called a fund of fund. Quant funds. The word quant is a short form of the term quantitative. These funds are quantitative approach. These funds use quantitative approach to invest in stock markets based on a computer generated mathematical model. So this will use a computer model for investment. That is what is called a quantitative fund or quant fund. Then you can also classify debt fund into five forms. Money market mutual fund, that's a debt fund. Short-term debt fund. So money market mutual fund means they specialize in investing in short-term money market instruments like treasury bills. Collect means CBLO, commercial paper, certificate of deposits. So they invest only in money market instruments, money market mutual fund. Short-term bond fund, they are funds that seek to provide high degree of liquidity along with generation of reasonable returns by investing in portfolio consisting of short-term debt and money market instruments. So some funds investing in short-term debt and money market instruments, they're called a short-term bond funds. Long-term funds, these funds investing long-term government dated securities and corporates. Gilt funds, mutual funds which invest exclusively in government securities. Some funds invest only in government securities. They are called gilt funds. Floating rate funds. Floating rate funds are non-traditional funds which invest in floating rate instruments because they invest only in instruments which actually give different rate of interest, floating rate of interest. So some funds invest in instruments having floating rate of interest. They are called floating rate funds. So with this, we actually end this video here. So far we have explained what is mutual fund and how is it organized and what are the different types of mutual fund. So in next video onwards, we will discuss the advantages, problems, and the present condition of mutual fund in India. So let us stop here for the time being.